SAIL is often called a sleeping giant, but the narrative for 2026 has shifted to volume and protection. They recorded 2.1 million tons in December 2025 sales, up 37% year-over-year. Anti-dumping duties from January 2026 are protecting the domestic market from Chinese dumping. The Vision 2030 goal is a 1 lakh crore expansion, with the key challenge being debt management during scaling. Q2 FY 2026 saw weak numbers, with net profit down 53%. This drag was due to margins collapsing to 9.5%, as coking coal prices remained high against cheap steel imports. However, December 2025 provisional sales of 2.1 million tons suggest a strong turnaround is imminent. Net debt stands at 26,400 crore, which is manageable for now, but a concern as new capex starts. The provisional December 2025 sales of 2.1 million tons, up 37%, indicate a strong volume beat. This turnaround suggests that government infrastructure spending is finally translating into increased steel offtake. This offsets the Q2 profit drop, caused by high coal prices and margin pressure. Key strategic triggers include the safeguard duty imposed in January 2026. This 12% duty on steel imports creates a price floor, allowing SAIL to hike prices. The Vision 2030 expansion targets capacity from 20 to 35 MTPA, requiring a massive capex. However, the risk of high coking coal prices remains, as SAIL imports most of its coking coal. The red flag checklist highlights 3 major risks. SAIL has one of the highest employee cost burdens. They also face a history of project execution delays. Finally, they are vulnerable to cyclical downsides, particularly if China's real estate crisis impacts global steel prices, despite import duties. When comparing peers, JSW Steel is an efficiency machine for consistent compounding. SAIL is best suited for tactical trades when valuations are low or policy is favorable. Versus Tata Steel, which is weighed down by UK operations, SAIL offers a purer play on Indian infrastructure. As of January 2026, SAIL is trading near its 52-week high, driven by record sales and the new safeguard duty. The stock is categorized as, quote, tactical bullish. Valuation-wise, the PE is elevated, but the price-to-book ratio appears cheap compared to peers, suggesting a potential value trap or opportunity. The future outlook for FY 2026 is focused on the policy play. With import duties and record sales, the stock may test 165 to 170 rupees. Q4 FY 26 is expected to be the strongest quarter. FY 2027 is the capex drag, as heavy spending for 35 MTPA expansion will turn free cash flow negative. Analyst targets range from a bearish 128 rupees to a bull case of 175 rupees. The final verdict is a BIY for traders, targeting 165 rupees, based on the potent short-term trigger of import duty plus record volumes. For long-term investors, we suggest avoid or switch to Jindal Steel and Power. SAIL's inefficiency destroys capital over long cycles, while JSPL is a more efficient long-term option. SAIL should be viewed as a cyclical trading bet, not a core portfolio stock. If you found this stock review helpful, please like, share, and subscribe. Also, feel free to drop a comment below on the stock you would like reviewed next.